Welcome to another episode of Equity Mates here on AusBiz. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going?
I'm very good, Bryce. Great to be back for another Wednesday.
Yep.
Watchlist Wednesday, our favourite time of the week.
Love it, love it.
Even better this week because it's been a short week for us.
Yes, it has been.
It hasn't been a short week for the market.
No.
Hasn't been a short week for anyone that works in finance. But here at Equity Mates, we took the public holiday.
Yep, that's how committed we are here at Equity Mates. Took the public holiday, feeling refreshed, and it's great to be back. And as you said, Watchlist Wednesday, and we're joined by a guest to take us through 3 stocks on his watch list.
That's right.
So it is our pleasure to welcome to Equity Mates Michael Wayne. Michael, welcome.
Thanks for having me, guys. It's good to be here. Finally, I've made it.
Well, yes, it's great to have you, and we're really looking forward to your 3 stocks. For those of you who haven't come across Michael before, he is the Managing Director of Medallion Financial Group, has plenty of experience in markets, and we've got 3 stocks to go through today. So, Michael, let's start at the top. The company on your watch list is Audinate Group. The ticker is AD8. What does the company do for those that haven't come across it before, and why is it on your watch list?
Yeah, so basically it's a high quality technology related business. Effectively what they do is they're involved in the digital audio networking technology space, and it seems a little bit more complicated than it is, but if you think back to old electronics and all the cords and the cables required to connect up those instruments, essentially Audinate has a protocol called Dante, which is embedded in all those different electronic items, which allows those different pieces of technology to communicate with each other. So the whole thing is essentially they work with companies like Yamaha, Sony, Bose to ensure that the Dante protocol is incorporated into their products. And essentially it allows these types of companies to provide technology which is used for outdoor entertainment, large sporting events, and those sorts of events and final products. But essentially, Audinate and this Dante protocol is getting adopted about 18 times the nearest competitor. So it's got an enormous competitive advantage over its peers at the moment. Over around 80% of new electronics products coming to market includes one of the Audinate protocols. So a good way to think about it is similar to Bluetooth technology, but Bluetooth is a cooperative and the quality of the technology is probably not as good as this Audinate. So in our mind, it is foreseeable that into the future that this particular product could become a monopoly of sorts. They also are now looking to branch out into the digital video space. So that's effectively doubling their market potential. They've had some early signs of success in that video space, and they continue to do very well in the audio space. They obviously took a little bit of a hit through COVID. There was no outdoor entertainment, there was no big sporting events, and that did put them under a little bit of pressure there for a while, and they did track sideways, but they've come out of that COVID period in a very good position. They've won a lot of market share during that time. Their order backlog book or their order book is looking very, very juicy indeed. They are facing a few headwinds at the moment. Some of the supply constraints that are affecting a lot of other businesses out in the tech space are affecting this company too. But we do think that that's more of a transitionary issue, and over time they should overcome that and continue to deliver on what they've been doing well for a number of years now.
Michael, it sounds like a fascinating company, and Bryce and I should maybe be a little bit ashamed that we've been in the podcast game for 4.5 years. We're all in on audio, and yet we haven't heard of Audinate. And it sounds like the technology is being broadly adopted across the world. Can you tell us a little bit about the business metrics? Is it profitable? Is it growing revenue? How do the numbers look?
Yes, so they're growing their revenues very, very quickly. If you look at the fourth quarter of FY20 relative to fourth quarter of FY21 relative to the previous fourth quarter of FY20, they saw a 74% increase and an uplift in their revenue numbers, which is very, very good. Obviously, you can see that the 2020 numbers were probably very heavily affected by COVID, but they've clearly come out the other side. At this point in time, it's not profitable from memory, but as this business scales, you can see that the things like margins and whatnot will also increase significantly over time. Look, it's one of those businesses where they've spent a lot of money in the investment phase. And now they're starting to pay dividends, or not pay dividends literally, but they're starting to see the dividends of that investment. It's one of those high growth type companies which has sacrificed those traditional metrics such as profitability in order to invest in their business, build out their market share, and really take a dominant position over their competitors. But in time, if they continue to deliver these sorts of numbers, they should very quickly emerge as a highly profitable company.
So moving to your second stock now, Michael, and that is Vicinity Centres. The ticker is VCX. Again, what does Vicinity Centres do, and why is it on the watch list?
Yeah, so a very different style of business to Audinate. This is very much an old world type company, but old can be very good at times. So Vicinity Centres basically is a real estate investment company. They own the Chadstone Shopping Centre down in Victoria, the Strand Arcade, the QVB up in Sydney, many people will be familiar with, some of the direct factory outlets around the place as well. So the biggest shareholder is the Gandel family. They're one of the largest and wealthiest families in Australia. And this is a business that they founded many years ago now. But as an investor, you get an opportunity to invest alongside that name, if you like. But the whole thing is obviously because of the COVID situation, this is a business that suffered incredibly as a result of that. We've seen lockdowns across Victoria and New South Wales in very recent times, and across most states at different intervals over the last 18 months. And that's affected their business and it's affected their share price. Once upon a time, this company traded around $2.50, $2.60 a share. It's now come back a long way. It's trading around $1.60, $1.70. I haven't checked it in a couple of days, but it gives you a good combination of potential upside in the event that we do reopen and things do return to a pre-COVID environment. We've also got the chance of a potential uplift in dividends. Even at these prices, the dividend per share of around 10 cents equates to around 5-6% dividend yield. We would expect that over time, that dividend per share would start to increase back towards where it was pre-COVID at around 16 cents. So if you are becoming an investor at this point in the cycle, not only is the opportunity for capital growth, as I said, even when things normalise, there's opportunity to get a decent dividend while you wait for that to happen, but there's also the opportunity that your dividend per share and your dividend yield on your initial entry position can grow over time. So it's obviously a more stable business than many in the tech space or many other sectors of the market. It's probably the highest quality of the real estate businesses in our view anyway, on the market at the moment. Very strong balance sheet. They've got a few development projects in the pipeline as well. Very strong tenant base. The major tenants that occupy their centres are people like Woolworths, Coles, Wesfarmers, Accent Group. So it's a very high quality business that we think should benefit from that reopening theme that everyone keeps hearing a lot about at the moment.
So Michael, you mentioned some of the, flagship properties that Vicinity own, the Chadstone Shopping Centre in Melbourne, QVB building in Sydney, and then a number of DFO buildings around Australia. It sounds like it's quite exposed to retail as opposed to other parts of the property market like office or industrial. Has the company given any commentary on how they think retail is going to emerge post-COVID? With consumer shopping habits changing, the shift to e-commerce and the like. Have they given any commentary on how they think shopping malls are going to respond?
Yeah, so essentially they're looking to make it one of those one-stop shop type environments, similar to what Westfield has done in recent times, where it's a lot more food orientated and you make it more of an experience rather than just an out-and-out shopping experience. So they have invested in doing things like that. They are diversifying, believe it or not, into areas such as office towers. That way they get a bit of a blend, if you like, between the commercial rents and the retail rents. They're also into sort of that mixed use type development, which obviously includes things like commercial, residential, and also some of the retail as well. But they are pretty well diversified across the country, a lot of exposure to Victoria, New South Wales and WA. And you could argue though that this particular real estate company is probably most aligned to a reopening in Victoria. So if we do start to see things return to normal down south, then this is a company that we would expect to benefit the most from that. As you touch upon, there definitely will be changing habits and tastes that are sustained even after we leave the lockdown environment. But given that they own these flagships locations and flagship stores, we think they're in a pretty decent position, maybe not to recover entirely to where they were pre-COVID, but even if they get between where they are now and somewhere in between, you're still doing quite well on a total return basis, given the strong yield, potential upside in that dividend per share, as well as a slight recovery in the share price. But you definitely make a very good point. And for that reason, it's one that you would want to continue to keep an eye on and monitor over a 6-12 month basis once you get that initial recovery in the share price.
So Michael, now to your third and final stock, and that is XRF Scientific. The ticker is XRF. Again, what does it do and why is it on the watch list?
So this is another business in another sector. So I thought I'd go for 3 companies across 3 different areas of the market today. This is a kind of mining services type business, but more on the technology side, if you like. So if you think about when a lot of mining companies, they're doing their exploration, they go out, they drill a large core sample out of the earth. They've then got to test that core sample to see what the quality of the material that they are exploring for. So XRF Scientific effectively provides these companies, many of the big miners, like Rio Tinto, BHP, Vale, South 32, they'll provide them with the machinery, which will allow them to then test those core samples. But it won't only provide the machinery, it'll also provide the chemicals, which are called the consumables, which is the part of the business that we like the best, because obviously once you consume that consumable once, you've then got to go and repurchase another replacement. So it's a very good quality business. The balance sheet is very strong. This is a profitable company. It's not a very large company. It's been around for some time, but they're definitely growing off a low base. They're not growing at ultra high levels like, say, a tech business, but they're growing at a very sustainable rate, which over time can compound quite well. They don't trade on the same multiples that many of those fast-growing tech companies trade on. So it doesn't always have to be about the biggest absolute growth numbers you can find. There's always businesses that are priced correctly can be attractive. So XRF fits that mold for us. What we like is that the part of the business that's actually growing the most is not the consumables, it's actually the new equipment. That might seem like a negative because the biggest margins from the business come from the consumables. But the thing is, if they sell more machines now, guess what? In 12 months' time, 18 months' time, 2 years' time, the people that bought those machines will then need to buy and update their consumables. And there'll be more machines out there which need more consumables. And over the long term, we think that that's a very attractive business and a very attractive proposition. So for us, it pays a decent yield as well of around 3%, was slightly higher until the recent rally in the share price. But we think given the environment in mining, not just in iron ore, but across the commodity suite, this is a company that can continue to benefit from the amount of exploration that is going on out there. And we do expect that the exploration numbers, particularly in places like copper and uranium, could well increase in the years to come as these commodities become more sought after. And this is a business that will benefit enormously from that. It should be made clear that not all their customers are from the mining sector. They've got a big use across other industries as well. But we think that this is a smaller micro-cap type company, which, although it is on the smaller end, has a pretty established business and a pretty established path to growth, we think.
So Michael, XRF has had a pretty incredible 6 months, up over 100% in the last 6 months. What's happened? Has the market just all of a sudden discovered it, or has something about the business improved or changed that's seen it more than double its market cap in that space of time?
Well, you've seen a pretty impressive increase in earnings. This is a company, again, that spent a number of years investing in their technology. They weren't profitable for a long period of time, but now all that investment is starting to pay off from them. And you're seeing the first half profit numbers, for instance, were up significantly, obviously off a low base, but starting to sort of deliver on what the management was saying. You've seen margins obviously pick up significantly as well. So after a long period of constrained earnings, you're starting to see all that investment really pay off. And I think the market does like to see that. Often management teams talk about being profitable down the track and delivering a dividend at some point down the track, but it always continues to get pushed out for whatever reason. In this instance, it's certainly a company which has delivered on exactly as it said, and I think the market is rewarding it for that. There potentially is, often with companies of this size, it is poorly covered. It's harder for big funds and big managed funds and big super funds to be able to invest in something of this size. So if you're an individual investor and you can identify a company with these quality traits, if you can get in early, over time as the company grows in size, many of the funds start to catch on, and you can get a big uplift as it gets to a certain size where it can allow a certain amount of liquidity which can get these businesses, which can get these funds invested. So yeah, no, there's definitely been a number of reasons why the share price could potentially have lifted. It has taken a bit of a hit in the last couple of weeks, but it's an opportunity in our eyes to pick a quality company up.
Nice. Well, Michael, it's always a lot of fun hearing about new stocks from our experts who join us on the show, and it's been an absolute pleasure hearing some new ones from you today. So we very much appreciate your time. I know a lot of our community would have taken a lot of value from that, so thank you very much.
No, thanks very much for the invite, and fingers crossed they go all right.
Fingers crossed, I'm sure they will. Thank you. And that brings us to the end of Watchlist Wednesday here on AusBiz. If you would like more info on what we're doing at EquityMates, head to equitymates.com, or you can reach us at contact@equitymates.com. But Ren, we're back tomorrow to close out the week.
That's right. We're going to be joined by another expert, and we're going to have one stock and one ETF to add to your watch list. So if you can't get enough of Watchlist Wednesday, make sure you join us tomorrow, and we'll keep this party going.